If you've walked past a jeweler or a bullion dealer lately, you've probably noticed the numbers in the window look like they've been hit by a turbocharger. In April 2026, gold has moved from being a boring insurance policy to the best-performing asset in many Australian portfolios. But before you rush out to buy a gold bar, you need to understand that the 2026 gold market is fundamentally different from anything we've seen before. Today, I'm going to break down why gold has just smashed through the 6,500 Australian dollars per ounce mark, the hidden insight about the Australian dollar that determines your profit, and exactly how you can buy in without getting ripped off on premiums. Let's start with the baseline. As of late April 2026, the spot price of gold in Australia is trading at approximately $6,548 per ounce. To put that in perspective, just a few years ago, we were looking at numbers closer to $3,000. We are currently in a historic bull market driven by two massive forces: global central banks buying gold at the highest rates since the 1970s, and a massive flight to safety due to shifting trade policies. But here is the anchor most Australians miss. When you buy gold in Australia, you aren't just betting on gold, you're betting against the Australian dollar. Gold is globally priced in US dollars, so your profit is a result of two moving parts: the price of gold in the US and the strength of the AUD. In 2026, we've had a perfect storm. While gold prices in US dollars have surged toward $4,700 an ounce, the Australian dollar has stayed relatively flat against the greenback. This double whammy is why gold has felt like a rocket ship for local investors. Image showing gold price in AUD versus gold price in USD 2024-2026. So how do you actually buy it? You have three main paths in 2026, and each one has a very different cost structure. The first path is physical bullion. This is the classic move, buying gold coins or cast bars from places like the Perth Mint or a private dealer. In April 2026, a 1-ounce Perth Mint gold minted bar will set you back about $6,708. Now, if you're doing the math, you'll notice that's about $160 above the spot price. This is called the premium. In 2026, premiums on physical gold are at record highs because the physical supply literally cannot keep up with demand. If you want the clink of gold in your hand, you have to be willing to pay that 2% to 4% entry fee. The second path is the digital gold move, ETFs. On the ASX, the most popular option is PMGOLD, the Perth Mint Gold ETP. In 2026, it is trading at roughly $65.28 per unit, representing about 1/100th of an ounce of gold. The hidden insight here is the management fee. PMGOLD has a management fee of just 0.15%, making it one of the cheapest ways to own gold in the world. Unlike a physical bar, there is no premium to pay a dealer, and you don't have to worry about a $5,000 safe in your floorboards. You can buy it through your regular brokerage app like ComSec or Perler, just like a share. Table comparing physical bullion versus gold ETF. Premiums, storage fees, and liquidity. The third path is the aggressive play, gold miners. This isn't buying gold, it's buying a business that digs gold out of the ground. On the ASX, companies like Northern Star Resources or the VanEck Gold Miners ETF GDX provide what we call operational leverage. This is a fancy way of saying that if the gold price goes up 10%, a miner's profit might go up 30% because their costs to dig it up are fixed. However, this works both ways. In March 2026, when gold prices dipped slightly, some Aussie miners fell 3 times as hard. Mining is for people who want to turn a gold trend into a high-growth investment, but it comes with a much higher heart attack factor than owning the metal itself. The most important question for 2026 isn't how to buy gold, but how much to own. Most financial advisors in Australia are currently suggesting a portfolio insurance model, which means keeping about 5% to 10% of your net worth in gold. In 2026, gold is acting as the ultimate hedge against a sticky inflation environment where your savings account is struggling to keep up with the cost of living. But here is the move that nobody talks about: the tax trap. Many Australians assume that because gold doesn't pay a dividend, it's private wealth. That is a dangerous mistake. The ATO is very clear. Gold is a capital gains tax asset. Whether you sell a gold bar back to a dealer or sell units in a gold ETF, you are liable for CGT on the profit. However, if you hold that gold for more than 12 months, you qualify for the 50% CGT discount. This is why gold is a long-game asset. If you try to day trade gold in 2026, the tax office will take a massive bite out of your upside. The reframe for 2026 is this: gold isn't a way to get rich quick. It is a way to stay rich. It is the only asset that has zero counterparty risk, meaning it doesn't rely on a bank, a government, or a CEO to maintain its value. In an era of $1.1 million median house prices and volatile share markets, gold is the anchor that keeps the rest of your portfolio from drifting away. If you're looking at the $6,500 price tag and thinking you've missed the boat, look at the central bank data. When the world's biggest financial institutions are still buying gold at these record levels, it tells you they are preparing for a long-term shift in the global economy. Being behind doesn't mean you can't start small. You don't need $6,500 to start. You can buy a single gram for about $246 at the Perth Mint, or a single ETF unit for $65. The goal isn't to guess the top of the market. It's to make sure that when the next global shock hits, you have a piece of the only insurance policy that has worked for 5,000 years. Gold isn't a destination, it's a foundation, and in 2026, that foundation has never been more important for the everyday Australian. If you found this data-driven breakdown valuable, hit that subscribe button and turn on notifications for more Australian finance insights. Thanks for watching, and I'll see you in the next one.